All right, let's jump straight into SMX today. It's this traceability platform that's, right at the intersection of supply chain integrity and all this climate compliance stuff. And look, everyone is watching the day-to-day price action, but the real story, the thing that I think fundamentally changes the risk here is that massive new $111.5 million flexible equity deal. I mean, the capital just changes their entire financial runway. It de-risks the company for what is a really critical near term for them. So to unpack this, at its core, SMX is trying to solve these huge industrial scale problems with some pretty advanced tech. We're talking molecular markers embedded right into materials, and they combine that with what they call blockchain digital product passports. So this isn't just, slapping a QR code on a box. This is about giving the actual material a verifiable digital memory.
Precisely. You're listening to the show where we take these complex financial and technological stacks and break them down into practical knowledge you can actually use, so I'm glad you're with us. Because this really is a story of a potentially foundational technology that, well, until very recently was facing a pretty serious existential capital problem.
And before we get into the tech, if you're finding this analysis useful, please make sure you subscribe. That way you won't miss our next breakdown. We love digging into these kinds of asymmetric opportunities.
All right, so let's establish the fundamental setup for SMX. To really get the opportunity here, you have to understand the risk profile first. This is an early-stage company. Yes, they are generating revenue, which is great, but crucially, they are still loss-making. They've been burning cash to build out this whole platform.
Right, and that's the part that historically scares the market off, isn't it?
Yeah.
Why pour money into a loss-making company, especially one with what seems like really high fixed costs?
Because they follow what we call a classic J-curve setup. Think of the letter J. The company spends a ton of time and, more importantly, a ton of capital. That's the line dropping down on the J. Investing in R&D, patent protection, getting all the regulatory compliance, building out commercial teams, all of that is high fixed operating costs. And during that phase, revenue's small, so they lose money. But, and this is the whole promise, the underlying business model is fundamentally IP and software heavy. They're selling the markers, the special readers, and the blockchain sauce platform. So because their costs are mostly fixed, once those deployments start to scale up, they should achieve some pretty substantial operating leverage.
Which means, in simple terms,
It means every new dollar of revenue, once they hit that critical mass, costs them very, very little to generate. They're basically building the factory right now. Soon they'll just be selling the product. That's when the financial picture flips and that curve of the J just shoots up, hopefully, very rapidly.
But that whole transition from investment to profit has been held back by a really glaring weakness, which was financing. I mean, historically, SMX had limited cash. And frankly, they had to disclose substantial doubt about continuing as a going concern. That is a terrifying footnote for any investor to read.
That capital risk was the primary overhang on the stock. It was the big dark cloud. And this target capital facility, it just directly removes that immediate threat. It's the lifeline.
Okay, can you break down the structure of that $111.5 million deal for us? Because it's not like they just got a simple bank loan.
No, it's more clever than that. It's structured in two parts. First, there's an upfront purchase of an $11.5 million convertible promissory note. That's the immediate cash. Second, and this is really the key part, it's an option for Target Capital to purchase up to $100 million in SMX ordinary shares, and that's over an extended period of time.
Okay, so what makes it flexible? Why is that so important?
It's flexible because SMX has the discretion over that $100 million part. They can draw down that equity financing as they need it. It's on demand. So that gives them this incredible balance sheet flexibility. They can fund their commercial expansion without taking this massive immediate dilution hit. It swaps a severe near-term solvency risk for a more manageable long-term shareholder risk.
Okay, but speaking of manageable risk, let's hit that head on. It is equity linked. I mean, existing shareholders are paying for this runway through future dilution when those shares get issued. Is that the right trade-off?
It absolutely is, because the alternative was possibly going bankrupt, which would make all the shares worthless. So yes, the key for management now is just discipline. They have to manage the drawdowns by consistently hitting material commercial milestones, use the money to fund expansion that drives revenue, and the dilution is justified. If they just burn it, that's when it gets painful.
And this is where we get to that quirky little detail that kind of makes them stand out. They have this unusual option to use some of the proceeds to buy Bitcoin or other crypto as a reserve asset.
Yeah, it's highly unconventional, isn't it, for an industrial tech company focused on things like gold and rubber, but I think it serves a really strategic purpose. On one hand, it signals digital treasury diversification, but it's also, I think, a brilliant marketing angle. It appeals directly to crypto-savvy investors who already get the whole digital passport and Web3 concept. It frames them not just as an industrial tech stock, but as this traceability plus digital reserve play. It just gets more eyeballs on them.
Okay, so it's good they fixed the money problem.
There.
But if the underlying tech isn't competitive, the cash doesn't really matter. So let's pivot hard to their actual mode. Why can't a competitor just use RFID tags or a regular barcode?
Because SMX's moat is built on what they call material level identity. See, traditional tracking is all at the packaging level. If I buy an expensive pair of sneakers, the barcode is on the box. If I throw the box away, or even worse, if a counterfeiter puts a fake shoe in a real box, the entire tracking system fails completely.
That makes perfect sense.
SMX solves this by embedding molecular markers. Think of them like tiny, invisible, non-toxic chemical signatures directly into the material itself. It could be a solid piece of metal, a liquid solvent, or a rubber compound. They are literally giving the material its own unique DNA. You need their specialized hardware to read that signature, and that signature verifies the whole history on their blockchain digital passport.
So the markers are like a permanent digital birth certificate that you can't scrub off or fake.
Exactly. That's a great way to put it. The marker persists through processing, through heat, chemicals, even through recycling loops. This gives them a huge structural advantage in solving really high-stakes problems. We're talking sophisticated counterfeits, stopping corporate greenwashing, where companies claim recycled content they don't actually have, and crucially, enabling a true closed-loop circular economy.
And that ties directly into the massive regulatory pressure we're seeing all over the world. Things like the EU Green Deal, the Corporate Sustainability Reporting Directive, CSRD. These laws are making this kind of traceability a non-negotiable. It's not a nice-to-have anymore.
They're aiming to be the compliance solution for industries that just cannot risk being non-compliant. Against a pure software or barcode provider, SMX can credibly argue that only an embedded identity, something deeper than the label, can solve these problems. The market is being dragged to their solution by governments.
Which brings us to the commercial catalysts. We're starting to see a real shift now from just isolated pilots to multi-vertical commercialization. Where is the growth actually happening right now?
Precious metals is the most mature vertical, and it's fascinating because they're positioning themselves to be a de facto standard setter. The partnerships with Goldstrom and the Bougainville refinery are key here. Goldstrom is integrating SMX's entire system, the markers, the passports, into their advisory services for the entire gold and silver supply chain.
Wow. So think about the scale of the problem they're solving there.
It's massive. End-to-end traceability for gold and silver, from the mine all the way to the mint. This is huge for combating illegal sourcing and verifying ethical labor practices. If they define the standard for the industry, the upside is just enormous.
And they're not just stopping at high-value things like gold. We're seeing a big expansion into industrial rubber, right?
Yeah.
Specifically latex and rubber gloves.
It is a very practical, high-volume application. The target market is huge. That industry generates one of the largest post-use rubber waste streams in the world, and contamination is a nightmare for recyclers.
Okay.
By marking the material at the source, SMX provides certainty about the rubber's composition, its history. It makes large-scale, high-quality recycling finally economically viable. They are tackling these huge contamination challenges head-on.
And if we look just a little bit ahead, the next big imminent catalyst seems to be in fashion, with a Q1 2026 expansion into denim and recycled denim. This hits that sustainability mandate every major brand is battling right now.
Exactly. Fashion brands are under immense pressure to prove their recycled content claims. SMX gives them the tool to actually verify that their new jeans really contain, say, 20% recycled fiber. It's a system auditors can trust because the signature is physically in the thread. So it hits sustainability, material verification, and it even helps them manage their excess stock inventory more responsibly. The momentum is firmly bullish.
The market seems to agree. We looked at the quantitative sentiment scoring for all the recent headlines. The funding, the metals deals, the rubber expansion, and pretty much all of them are rated as somewhat bullish to strongly bullish. The news flow is definitely positive.
The setup is certainly exciting, but, we have to be realistic. This is a high beta, high risk investment. We need to face that bear case head on.
Let's do it. We've managed the capital risk, but what keeps the bears up at night now?
Execution risk. Number one, hands down. SMX is trying to scale a really complex, multi-stakeholder solution across these deeply entrenched, often conservative, and incredibly diverse industries. You've got metals, rubber, fashion.
Yeah, that's not like downloading an app. You're trying to change how an entire factory works.
You're changing the entire supply chain. That requires technical integration, it requires behavior change, regulatory acceptance. All of that complexity just lengthens the sales cycles dramatically.
So even with the proven tech, the hard part is just getting the global industrial machine to adopt it quickly.
Precisely. Adoption takes time, it takes patience. And the company needs to manage its cash burn until those long sales cycles start converting into real, repeatable revenue. And secondly, we have to circle back to the dilution risk. As we said, that $111.5 million facility, while critical, means issuing more shares down the line. It is absolutely imperative that they justify those future share issues by showing clear, rapid revenue growth. If they don't hit those milestones, that necessary dilution becomes hugely damaging to shareholder value.
And finally, volatility. I mean, SMX is a microcap. The liquidity is pretty thin. What does that mean for someone looking to get in?
It means you have to be prepared for a wild ride. Thin liquidity means if just one large investor decides to sell, there might not be enough buyers ready to go, and the stock price can drop like a rock. You get these sharp percentage moves in either direction.
So the risk is high.
The risk is high, but that volatility is also what enables the kind of asymmetric upside we're talking about.
So if we put this all together, the thesis positions SMX as a kind of high beta opportunity that aligns perfectly with these massive global trends, ESG, circular economy, compliance. What's a realistic time horizon for this storage to really play out?
For the platform to reach full scale, to generate that strong operating leverage and show sustained profit, this is absolutely a multi-year hold. I'd say 2 to 4 years easily. However, significant tactical upside could come much, much sooner, specifically from near-term catalysts in the next, say, 3 to 9 months.
And what are we watching for?
We're watching for the successful large-scale rollouts in Q1 2026 for denim and gloves. And we're watching the market's reaction to the first couple of successful drawdowns on that capital facility. Those are the immediate inflection points that will tell us if the scale-up story is real.
That's the lowdown on SMX for today. It's the classic high-risk, high-reward proposition. A foundational technology that solves billion-dollar problems, now finally backed by the capital to execute. The biggest question for you to mull over is this. Can their commercial execution across rubber, gold, and fashion keep pace with the massive transformative potential of their embedded technology? If you haven't already, subscribe so you don't miss our next analysis. We'll catch you on the next one.